Hi everyone, welcome to the session. In today's session, what I'm going to do is I'm going to discuss about a very important ratio called solvency ratios. Okay, under this, what I'm going to do is I'm going to discuss three main ratios, namely debt to equity ratios, then interest coverage ratios, and debt service coverage ratios. Okay, what is the solvency ratio and what is the purpose of calculating the solvency ratio? So let's look at solvency ratios are financial ratios used to measure a company's ability to meet its long-term obligation. Okay, so basically to evaluate the financial leverage of a company. Those ratios are important because they help to assess the company's ability to pay off its debts and other long-term obligations, whether the company's ability to pay off its debts and other long-term obligations. Okay, so this is the main purpose of calculating the solvency ratio. Now, one commonly used solvency ratio is the debt to equity ratio, which measures the amount of debt a company has relative to its equity. So, which means, so what is the amount of debt compared to its total equity? Okay, so that is the debt to equity ratio. The formula for the debt to equity ratio is total liabilities. Here, the total liabilities means long term and short term debt divided by shareholders' equity. A lower debt to equity ratio is generally preferred as it indicates that a company has less debt relative to its equity. Okay, so which can make it easier to obtain financing and reduce the risk of financial distress. The higher the debt to equity ratio, the higher the financial risk, and it indicates to what extent the company can pay off its total debt. Okay, so it's a very important ratio that we can calculate, debt to equity ratio. The second one is the interest coverage ratio. Okay, so what is the purpose of calculating the interest coverage ratio? This measures the company's ability to pay its interest expenses using its earnings. Okay, to what extent our interest expenses are covered by our earnings, the company's earnings. Okay, the formula for the interest coverage ratio is earnings before interest and tax divided by interest expenses. Now here we need to identify EBIT, earnings before interest and tax. Okay, since we are going to calculate interest coverage ratio, you should take the earnings before deducting interest. Okay, before deducting interest, what is the earnings? What are the earnings earned by the company? That divided by the interest expenses. So that will give you the interest coverage ratio. The higher interest coverage ratio is generally preferred as it indicates that a company is generating enough earnings to cover its interest expenses. For example, let's say the company's earnings are, let's say, 300 million and interest expenses are 100 million. So 300 million divided by 100 million will be the 3 times. Interest expenses are covered 3 times by the company's earnings, which reduces the risk of default on its debt. Okay, so that is the second ratio. And the third one is the debt service coverage ratio. Okay, so here the debt service coverage ratio means basically you need to identify the total debt service. Okay, this total debt service consists of two components. Okay, your debt service has interest expenses, you need to service the interest, and also you need to repay your principal. Okay, the principal payment and the interest expenses. Okay, so that is the debt service coverage ratio, which measures a company's ability to meet its debt service obligation, including principal and interest payments. The formula for DSCR, debt service coverage ratio, is EBITDA, and EBITDA means earnings before interest, tax, depreciation, and amortization. So, as I explained you in the previous ratio, interest coverage ratio, here you need to identify the earnings before deducting interest. Okay, so that is called EBITDA. And also, if there are any lease payment also, it's better to add back. Okay, if there are any lease payment, you just add back and divide this by debt service. Okay, this includes the principal and the interest expenses plus the lease payments. Okay, higher DSCR is generally preferred as it indicates that a company is generating enough cash flow to cover its debt service obligation, which reduces the risk of default. Okay, so these are the three main ratios where we can calculate the solvency ratios. Okay, now what is the purpose of calculating debt to equity ratio? Let's look at the purpose of calculating debt to equity ratio. The purpose of calculating the debt to equity ratio is to evaluate companies' financial leverage or the extent to which it relies on debt to finance its operations. Okay, to evaluate the company's financial leverage. On the other hand, we can say to what extent the company relies on debt to finance its operations. Okay, so this is the main purpose of calculating the debt to equity ratio. The debt to equity ratio is calculated by dividing a company's total liabilities, as I told you, both total short-term and long-term debt by its shareholders' equity. The resulting ratio indicates how much debt a company has for every dollar of equity it has. Okay, a higher debt to equity ratio indicates that a company has a higher proportion of debt relative to its equity. Okay, if the debt to equity ratio is high, it indicates what you call compared to the equity, what is the proportion. Okay, which may indicate higher financial risk and potential difficulties in meeting its debt obligations. Okay, if it is higher, the higher the debt to equity ratio, higher the financial risk, and it indicates potential difficulties in meeting its debt obligations. Okay, the purpose of calculating the debt to equity ratio is to assess companies' risk of financial distress or the bankruptcy. Okay, as I told you earlier, the financial leverage, the risk of financial distress or the bankruptcy. Higher debt to equity ratio may indicate that a company has higher leverage and may be more vulnerable to economic downturns or changes in interest rates. This is very important. Okay, if it is higher, the company is more vulnerable to economic downturns, economic recessions, or changes in interest rates. Okay, it's more vulnerable. It can also indicate that a company has a higher reliance on debt financing, which may result in higher interest expenses and reduce the profitability. Okay, so that means the profit is less. So therefore, when you deduct the financing, which is the interest expenses, your total overall profitability will reduce. Debt to equity ratio is commonly used by investors, analysts, and lenders to evaluate companies' financial health and risk profile. Okay, so most of the companies, when you do the evaluation, financial analysis, okay, most of the investors they evaluate in terms of the company's what do you call the financial health and the risk profile. This indicates very good ratio. It helps them assess company's ability to manage its debt levels and meet its long-term obligations. A lower debt to equity ratio may be considered more favorable as it indicates lower financial risk and lower reliance on debt financing. If it is lower, then it's good for the company. However, the appropriate debt to equity ratio can vary depending on the industry, business model, financial goals of the company, and should be interpreted in the context of other financial ratios and metrics. Okay, so these are the three ratios which we can calculate under solvency ratios. Okay, so with that, I will conclude the session. I'll see you soon with another video. Until then, bye for now.